A lot to digest there over the last several hours. And what I'm going to try and do is bring this together in terms of how we look at the next 3 years in terms of our financials and what that means in terms of an investment case, an investment thesis, as you all can look at Diageo from an angle of being a more competitive, but more focused on returns and value creation for our shareholders. So if we start at the top line, and we all know growth is critically important, right? But it's critically important that we're focused on sustainable growth and profitable growth. So when we're looking at it from an angle of what are the building blocks, you've heard from John, right? Talking about North America. It has been challenged, but there's clearly some strong interventions around how do we build for a more competitive offering in that market, as well as a simplified go-to-market structure. The focus of the plan is to start stemming the share loss, get to holding share, and then growing share, right? So clearly, as John highlighted, we are looking at a mid-single-digit decline to a low single-digit decline, and then getting to a flat performance in North America over the 3 years. That's what this algorithm starts with in terms of that first big market for us, North America. When we look at the rest of the world, clearly we are seeing 3 to 5% growth on a sustainable level across those markets, all right? This is also about continuing to gain share in those markets, all right, across the board. So you've seen some examples of that. Alvaro brought that to life in terms of how we're looking at both volume and value share. Very importantly, too, keep in mind that particularly in India, supported by what we're seeing as good tailwinds from a demographic perspective, as well as the FTA, as well as Latin America, these are volume-led plans as well. And I think that's very important for you to keep in mind. Well, what does that mean then for the group as a whole? We're looking at circa flat to growing 1.5%, growing 2.5%. So if you really look at it from an angle of where will we be when we exit 29, we're looking at an exit 29 of about 2.5% to 3% top-line growth, but that is with North America flat. And keep that in mind, and if you go back to some of the stuff that Hannah talked about, clearly, if we see consumer confidence come back, and there is that correlation that she talked about, that we have seen historically, and if that historic bias plays out into the future as well, there could be some incremental improvements there. But at least for now, this is what we see as the top-line growth algorithm. So let me now start walking down through the P&L, because I want to make sure you'll get grounded in each one of the lines through. Gross profit. All right, I think there's a couple of myths that have been out there in terms of the fact that gross margin percentages are going to decline. Let me come back to that. Very importantly, we are focused on growing gross profit dollars, all right? In fact, gross margin percentage obsession, you'll have heard me talk about, has created a lot of issues for us in the past. That's not to say it's not an important metric, but again, it's always an outcome. It's a mathematical calculation. We want to grow our gross profit dollars, all right? Why is there a belief that with RTDs and playing a broader portfolio, we are going to drop our gross profit dollars? No, we're going to grow our gross profit dollars, all right? That is very clear in our plan. Why do we also feel the gross margin percentage at 60% plus can be maintained and growing going forward as we look at this post the 3-year period? Is there is volume growth that is coming through in this plan. That volume growth supports fixed cost recovery, all right? So clearly that supports margin percentage and gross profit dollars. You have got a very strong focus as you think about an improving mix, both from a category perspective as well as a country mix perspective, as North America continues to recover, right? And remember, we're playing the full spectrum. So that doesn't mean it's an either-or strategy, it's an and strategy, all right? And the third element is the productivity savings that Ewan talked about that will also support that. So we believe gross profit dollars growing and most importantly, maintaining that 60+% gross profit margin is what we have for the next 3 years. All right, as we look further down, and let's go to the next big line, which is A&P. Do we have the right levels of investment? Or more importantly, a question around have we cut too deep? So let me first start with the second element. We have not cut too deep. We've talked a lot about the fact that there was a lot of non-working dollars that was duplication, waste, that we've been able to pull out through the Accelerate program and a strong focus across the business around eliminating that. That's been about $300 million that we've been able to take out from the business. And that's not to say there isn't more to go for as we continue to think about the opportunities in that space. We have also reprioritized investments for where we see the growth. We have been returns focused. We have pulled back on investments where I've talked about the fact that it was actually losing money for us and losing money for our customers. Clearly not a good use of cash or capital or investments. So clearly, having done all that, we feel the level that we're at is very much a sustainable level of dollar spend. I'm talking about roughly in this ballpark, right? So it's not about an absolute dollar staying at 3.2 or 3.1 or 3. Ballpark, we're in the right area. What does that mean? You guys love to model. An outcome or an output of that is a circa 16%, right? We are not driving for a 16% or a 17% or a 15%, all right? We're talking about the dollars that we spend and how well does that generate returns, sufficiency, through the line, both above the line and below the line. End to end is the way we're looking at it. All right, overheads or SG&A. And I'm going to break this out a little bit over here just to make sure that everybody's grounded and clear. We are talking, as Dave highlighted, getting to an overheads as a percentage of our revenue of about 10.5%, putting us in that top quartile group of companies. What have we done? Well, Dave talked about the fact that we've made significant progress already to be able to implement that and move at speed. There will be some areas that will take a little longer, particularly as we look at the GBS piece, but these will start coming through as well. That's about $1 billion of savings that we're going to have. 850 of that is in what we are calling overheads, both in COGS and in SG&A. All right, so there's an element of overhead that sits in COGS as well. That's about $850 million in total. And we've got another productivity element that Ewan talked about of another $150 million. So in total, you're looking at $1 billion for an overall cost of about $1.2 billion. And I'm going to come back to that when I talk about cash. We have already taken a big chunk of that. About 70% of that has gone through our P&L in 2026 that we talked about this morning at that circa $752 million of a charge on restructuring. But this will really help as well as we look at the next line of our P&L, which is what does that mean in terms of operating profit? So for us, when we're looking at operating profit, again, operating profit dollars will grow. Top line growth we talked about, but most importantly, gross profit dollars improving. You've got the investment that we need in A&P, and you've got significant savings coming out of your SG&A line, right? That supports operating profit dollars growth at a mid-single-digit range over that 3-year period on a CAGR basis. There will be slight ups and downs, and I'll talk about why that is. If you looked at that previous slide, just remind yourself that we talked about that savings coming through. About 40% of that will come through in 2027. Another 55% of that will come through in 2028. All right? So you've got the bulk of that coming through in the next 2 years to really support that operating profit growth of circa mid-single digit. Well, again, mathematically, that means our operating margin percentage will expand. All right? So again, the fact that people talk about the fact that our margins need to suffer, our margins do not need to suffer. All right? Both at the gross profit level, but more importantly, growing operating profit margin, but critically, dollar growth. Free cash flow. So let me just ground everybody again here in terms of what we're talking about. 2026 was a great year. We had a strong focus on cash. We were able to deliver 3.2 billion. Two things I would call out to make sure that we're grounded on the right number as we look at this on a recurring basis going forward. All the numbers that I've talked to you about so far are on the basis as if the EABL divestiture has happened as of July 1. Okay? So when you look at this on a go-forward basis, keep in mind there's about 300 million of free cash flow that is delivered from the EABL business, right? So that automatically brings that 3.2 billion number down to 2.9. We did have a one-off tax benefit in terms of historic refunds that we received in 2026, which obviously will not recur. So your baseline is a 2.8 billion when you exclude EABL and that historic item. When you look at 2027, clearly 2027 is going to be impacted by the cash costs of the restructuring program of about 850 million, right? And then when you look forward, you're going to see that number grow. So I've seen some notes come out already that talk about, oh, cash is coming down by 2 billion. And keep in mind, 900 million of that is just that rebasing when you take out EABL, right? That's just a like for like. And then you do have an 850 million restructuring charge. But let's step back and look at this from a payback perspective. We're delivering about 1 billion in savings, right, for an 850 million cash charge. I don't think that's a bad use of capital in terms of a payback and a return, all right, to make this business more competitive, more agile as we look forward. You've heard Ewan talk about being disciplined and dynamic around our CapEx, returns focused. And you've already seen that in 2026, where we brought our CapEx down to circa just under 1.2 billion, right? We have the ability to do that. A lot of our investment that we're looking at going forward is very much around capacity, capability building, right? Cost reduction programs. There is the regulatory maintenance piece, et cetera, that's in there as well, but that's all well funded in that 1.25 billion that we've put into the model for the next 3 years, and we're working towards that target. So what does that mean when you pull it all together in terms of a growth algorithm? Well, you're looking at low single-digit organic net sales growth. I talked about that. Flat, 1.5, 2.5. So a CAGR of somewhere around that 1.5% with that assumption around North America. Mid-single-digit operating profit growth. I walked you through that. We would expect EPS growth to be ahead of operating profit growth on an FX neutral basis for translation, and that cumulative free cash flow that I explained of circa 8 billion, but you've got that like-for-like piece as well as the impact built in for the 850 million of restructuring cost. We've had a very disciplined and clear capital allocation focus. I think we've actually just not stuck to it as we should have. So I don't think it's really a change in how we think about it, outside of the fact that I think when we're thinking about investment for growth, we're very much returns focused, right? So if you think about that first bucket, where we talked about what we need to do for A&P, we've talked about what we need to do for CapEx, we've talked about what we need to do for maturing liquid, right? That maturing liquid piece you've seen come through in terms of what we've done in terms of a correction of that baseline, but more importantly, a process that's a lot more dynamic and flexible as we think about what we're laying down for the future, all right? And Ewan talked about that, whether it's monthly, quarterly, or biannual cadences with which we're looking at it, all right? So a lot more dynamic in terms of what we're doing. So clearly we've got a plan that is well funded from a perspective of investment that we want to make in the business. We want to return cash to shareholders. There's a value creation opportunity here as we continue to look at that, and I'll come back to that in a moment. And I think it would have been, odd if I didn't have that last box on the chart, because you all would automatically assume that we're trying to, not talk about it, but let me be very clear. This is an organic turnaround story. This is not about us going out to do any acquisitions, all right? So it's really the first two boxes that we're talking about. The first box is fully funded. What does that mean in terms of that second box? Well, Dave talked about this in the opening, right? The fact that we've been able to, with strong free cash flow generation and a rebasing of our dividend policy, be able to bring down our leverage from 3.4 times at the end of 25 to 3.1 times at the end of 26, all right? More importantly, as we know the disposal proceeds are going to come in for the two transactions that we have announced, about a 0.25 turn from the EABL transaction and about a 0.1 turn benefit from the RCB transaction, right? That, along with the free cash flow delivery, will help us get to the midpoint of our target range. This is about a year earlier than what we had even communicated to you all last year, right? So strong progress in that area. More importantly, absent any actions, which, as Dave said, that's a nice problem for our board members to have as we look forward, right? We can actually get down to 2 times by the end of 2029. All right? I don't expect we'd be there. Why? Because quite honestly, we don't want to have an inefficient capital structure either, right? We do believe the 2.5 to 3 times net debt to adjusted EBITDA is the right target leverage, but it is one that we will review annually and make sure, is it fit for purpose as we continue to look at the macro environment. But for today, with that, we clearly have a lot more financial flexibility to make the right choices and allow the board to make the right choices to think about how do we return excess cash to shareholders, i.e., do we increase our dividend payout? Do we do share buybacks? And I don't think it's a binary or decision. Again, it could be a combination. So it could be an and decision as well. But more to come on that. I'm sure you're going to want to build things into your model. Don't ask us more about it. When we get to that point, we will be able to share with you in a very nice way how we will think about that. But the whole focus around cash returns to shareholders and a capital allocation policy that's clear and disciplined is very much intact. 2027 guidance. Well, no surprise from some of the stuff that you've seen that I've highlighted. So we are guiding for broadly flat organic net sales growth, supported by low to mid-single-digit operating profit growth, and free cash flow of 2 billion after the cash charge for the restructuring. We expect the leverage, as I said, to be circa at the midpoint of our stated range of 2.5 to 3 times. So with that, I'm going to leave you with 3 things, right? 2027, profit growth and operating profit dollars growth in that low to mid-single digit. Number 2, we do not need a long-term margin reset. Hopefully, I've been able to demonstrate that to you from both a gross and a growing over the 3-year operating profit perspective, dollars and margin. And 3, we're going to have a lot more flexibility when you think about the leverage coming down at a much faster pace to allow us to do the right things for our shareholders as we look forward.